All right, hey everybody. My name is AJ Brown and thank you for having me back. I'm kind of excited because we're launching a new tool and this is the first time I'm going to be showing it off to all of you. It actually does a lot of the thought process for you in setting up these seven-figure income portfolios. So I'm really excited. My time is limited, so I'm going to rush through some of my presentation just so I can spend a little bit of extra time showing you this tool because I am just stoked beyond belief that it just got finished this past weekend. Here we go. 3 simple steps to generating a seven-figure income. Follow along. This is new and improved, by the way. I've given this presentation before, but with the new tool, this is new and improved. Now, I want everybody to picture this particular curve. I'm going to come back to it later, but I want you to notice a couple of things. I'm going to draw on this, show you what it's all about here. I want you to notice that this is the break-even line, the zero line, goes a little bit negative, goes really positive. And I want you to notice that there's a range low and a range high. And I want you to notice that after between 1 and 2, even the range low goes above break even, and then it goes up exponentially. That's what I really want you to notice, is that it goes up exponentially. I'm going to explain this better, but I want to imprint this into your mind from the beginning of our presentation. So let's keep going here. All right. I always start with this. Got to ask you, 50,000 today. Would you take a $50,000 wad of cash from me today, or would you take that penny that doubles every month? Let's go through the math. So 1 week in, I'm feeling a little bit regretful that I didn't take that $50,000 because I've only got 64 cents in my pocket. 1 week, if we say that a month is about 4 weeks long, gosh, I've already gone through like a quarter of the month and I'm not even over $1. But let's keep going. So now we're up to day 8, day 9, day 10. We're about a third through the month, and I've got $5.12. Still nowhere near that $50,000. Get it to about halfway through the month, $163.84. Half of the month is gone. What's happening here? Let's keep going. All right, now we're about 3 weeks in. I'm at $10,485.76, but I'm still nowhere near that $50,000. And it looks like I'm about 3/4 of the way through the month. But look what happens on the last week of the month. Right around day 24, about, I would say what? A little over 2/3 of the way through the month, I finally matched that $50,000. And now look what happens in the last few days of the month. We really skyrocket. We skyrocket exponentially, such that at the end of the month, if I would have taken that penny that doubles, I would have had $21 million, $474,836.48. So Einstein is attributed with this. I'm not sure if he actually said it, but we'll keep with it. Compound interest is the most powerful force in the universe, and that's what you saw here, that exponential gain if you let your money ride. Notice there was a lot of effort, and I was kind of in my cold sweats, white knuckling it in the beginning, but I was thankful at the end that I took that penny. So here's how the math works out. Everything I do, since I'm an engineer by trade, everything I do is math-based. If you earn 6% on your money, please write that number down, just 6% on your money every month. If we focus on 6%, I'm not talking about these things that home runs that people talk about that maybe you'll get once a year where you double your money or something like that. I'm talking about just focusing on a real doable 6% a month. If you focus on 6% per month and you compound that 12 times, you'll have an investment that doubles every year. So that means if you have $1,000 in the markets, in 1 year you'll have $2,012. In 2 years you'll have $4,048. 5 years you're going to have $32,000, almost $33,000. And in 10 years you're a bona fide millionaire. But here's the part I like even better. If you have a $100,000 portfolio, then every year you're going to generate $101,219.65. Now, the median income in the United States is just over $87,000. Now, that's not counting places if you're in, like, for instance, the coastal cities, you know, Washington, D.C., New York, L.A., San Francisco, Seattle, or Chicago. But for the most part, if you are earning over $87,000 a year, you're over the median income. The scoop is here you are letting your money work for you, and it's making more than the median income, right? So that's kind of exciting, isn't it? That's, in fact, really exciting. And the scoop is that median income that I talked about, that $87,000, comes with a 60-hour-a-week work week. 60 hours. This comes with a few minutes every evening. So let's talk about it. And I'm going to blast through this. Most of you know who I am. How many of you at the show of hands know who I am already? Yeah, that's what I thought. Some of you have heard of me. By the way, just out of curiosity, how many of you with a show of hands don't know who I am? Okay, well, I'll hit this just very quickly, but again, limited on time. Founded Trading Trainer, started doing equities and options trading in 1997. Been publishing my daily insights for my learning community full-time traders since 2002, 5 days a week. And this ebook's been around, and I see it on all sorts of traders for almost a generation now. For 20 years, that ebook's been available. And of course, I also have this home study course that you'll see on a lot of the gurus' shelves if you ever visit their office. My background is I'm a mechanical engineer. I focused on something called automatic controls. You might be familiar with that topic in the news because it's automatic controls is one of the reasons why the Boeing airplanes have been going down. The automatic controls software wasn't fully built out. Not because of the engineers, but mainly because of business decisions. And then, of course, the pilots who fly those planes aren't trained to fly them without automatic pilot. And so, of course, that's a bad combination. How many of you with the show of hands, by the way, have watched that Chernobyl mini flick that just went on? Yeah, right? You can see what happens when insult follows injury when you're managing something that many lives can be affected by. With that said, I've also got a strong background in commercial business and investing. And over the last 15 years, I've really been focusing on a new kind of focus, which is called accelerated learning methods. This is some of the best teachers in the world out there have been teaching people how to teach so that you can get material ingrained in people without having to go through the traditional learning process. I'm really digging that. You can see I'm just a big nerd. Now, in 1997, when I started options trading, I lost big. Not only did I spend $27,000 on seminars, and those seminars back then were the ones where you actually had to show up at a hotel on a Saturday. How many of you at the show of hands remember those, where you'd show up at a hotel, none of these webinars, and you'd spend the morning there, and then they'd upsell you to come back all day Sunday, and then after that, they'd try to get you to fly somewhere. I did all those Saturday and Sunday webinars. I spent $27,000 that first year. And then on top of that, trying to follow their trades, I gave $85,000 back in stupid investments. In fact, write this down. The key to my success was really cornering the same schleps like myself in that conference room that I kept seeing every weekend like myself, and cornered them at the water cooler at one of the breaks and said, hey, I've seen you coming to all these seminars. Do you want to try to do these things together? The minute you put together an investment group, you'll see no matter what program you're doing, you'll see your investments shoot through the roof. Mark my words. The other key fame that I had, by the way, is I have started a foundation. In fact, I started a foundation with some inner city gangbangers in Denver, Colorado. I took 14 of them. I'll tell you, 5 of them washed out. They couldn't handle the program, but 9 of them continued. And we actually did this program at a public library, and they limited us to being on the internet at the time to only 30 minutes a day. Now, imagine this. Folks with only maybe a 4th or 5th grade education, because honestly, public school system really lets inner city kids down. So imagine a whole bunch of folks, 4th grade education, only allowed to get on the internet 30 minutes a day. All of them were successful. In fact, what I thought at the end of the 6 months of working with them is that I'd give them each $2,000 of my own money. And I figured I'm going to be never seeing this money again. I'll have you know that every single one of that money came back to me. All of these kids wound up buying their own computers and their own DSL connections. Back then it was a DSL connection. That was the now we have fiber and we have Wi-Fi and all that good stuff. But back then it was DSL. They got DSL connections and one of them sent themselves to DU. So it was a real success, and we've run this foundation every year since. We've since moved it from Denver to Chicago, where there's a lot more inner city youth, and I've partnered with the Chicago Board of Options Exchange. And last year we graduated over 170 of these kids from our 6-month program. So I'm very stoked about this foundation. So let's get back to the content. Again, time is of the essence here. What minimum returns must you make monthly on your portfolio to more than double your money annually? What do you think? A, 0.5%, B, 1.5%, C, 5%, D, 6%, or E, 10%? If you're thinking D, you're spot on. All right. So we call these our instant income calendar investments. These investments are definitely less subject to wild swings. In fact, the big dip that we had in end of November, beginning of December, and then the big rise we've had since, and now the leveling off, none of that affected any of our trades. They could be immune to downturns in the stock market. They could be structured to profit from those downturns. You'll see those in a second. They have built-in profit buffers that you can also structure upside down. We're also going to show you how to solidly protect these above and beyond the profit buffer. That's a little bonus. And our focus, again, is to earn more than 6% per month on our investment. So how the heck are we going to do this? We're going to sell option premium. So what the heck is this thing called option premium? If you ever look up an option price, like for instance, I've got my Thinkorswim running because in the middle of giving this presentation, I'm also watching the markets. So I've got my Thinkorswim running right now. If you look up any of these prices, the mark is halfway between bid and ask. That price composes two different components. A component that's called in the money value and another one that's called premium. So if you think about it, the option price is always equal to the in the money value plus that premium value, right? So our focus is to sell that premium value and then have it decay away with time. Well, some of you might be saying, well, what the heck is an option? I've heard of them before. Well, it's a financial instrument. You hear it grouped in with futures under the term derivatives. And options are typically bought and sold by the market movers, the professionals. Sometimes we call them the drivers of the market. They sell them to hedge risk against their underlying symbol positions, their stocks, their indexes, and their exchange traded funds. What we're doing is we're using them mathematically. We're doing it differently than just hedging risk. Instead, we're selling premium. So I want you to write down the names of these 4 transactions, these 4 setups. Covered calls, covered puts. A lot of people know about covered calls, at least they say they know about them, but then when I quiz them about them, they only know the tip of the iceberg. But a lot of people don't know about covered puts, which is flipping the covered call upside down. And when I really question people about writing covered calls against leaps, I see them light up, and it's usually because they don't really know how to do that. We call that supercharged covered call writing and supercharged covered put writing. And just for you nerdy people like me out there, the actual academic name for writing covered calls against leaps and covered puts against leaps are called bull call diagonal debit spreads and bear put diagonal debit spreads. And it's actually a subset or variation of those, yeah? By the way, how many of you with a show of hands, you're following along just fine so far? I'm not going too fast. I do want to go fast, but I don't want to leave you in the dust. Good, good. Let me ask the opposite question. Let me put your hands down here. How many of you with a show of hands, I am going too fast? Okay, good. Not so many. Cool. Let's keep going. So let's run through a scenario here. I got General Electric. $10.23 is the going price. If I sell the $11 call against that, I'm going to make 34 cents. That means for every contract sold, I make a $34 instant dividend. That instant dividend is like a coupon. It's like I like coupon. It's because it's a wasting asset, right? All right. So what happens if GE closes above $11 on August 16th? Well, I'm going to get that $11. Because I paid $10.23, I get a 77% profit. I also made the 34 cents from selling the call in the first place. So I get $1.11. And on that cost basis, that winds up being 11.2% ROI. Let me stop right there. Please know that this example I'm showing you is actually the worst case scenario. Why do I say that? This is called a buy right. I'm buying GE and I'm immediately selling the call. That's not the way we typically do it, by the way. We like to leg into these positions. So please understand that this example is actually doing it the worst way possible. Now, what happens if GE is flat by August 16? $10.23. I make the 34 cents. I keep that 34 cents, and that's a 3.5% ROI. I get to do it again and again and again. What if GE drops by August 16th? Well, I've got that built-in profit buffer of 34 cents. It brings my break-even price down to 9.88. So built into the strategy, I can have this drop by a good chunk if you look at the GE chart. But we'll show you in a moment how we can even do better than this. We can protect it solidly. Let's keep going. But you get the idea. Here are some of the returns: 17% on Micron when the stock traded up, 15% on Activision, 34 trading days when the stock treaded water, and even when healthcare, Allscripts Healthcare, took a dump, our strategy made 14%. So let's answer all that apply. What does investing by selling premium create? Does it create an instant dividend? Does it create a security that's got a discount on it? Does it create a profit buffer? Does it create an expiring coupon? Which of these, or you can answer all that apply, which of these make the most sense? If you're thinking all, you're spot on. So let's keep going. Let's see what we can do to tune this up to the next level. I'm going to kind of zip past some of these returns. You can see 21% when the stock went up, 12% when the stock treaded water, 17% when it took a big dump. Okay, so this is a question I'm going to ask, not in review, but I want to know what you think. How can we lower our investment and increase our returns? And here's the one I like, and even convert a margin trade into a cash trade. Now, the reason why I'm saying that one, convert a margin trade into a cash trade, is this strategy is so conservative that I actually have all of my Roth and traditional IRAs in it. And it's really difficult, almost impossible, to do margin trades with your tax-free and tax-deferred accounts. So we like anything that can convert something from a margin to a cash trade. Okay, how do we do it? Do we sell out in time options? B, do we replace the security with options trading at parity? C, give up and buy mutual funds? Or D, what I'm talking about is a pipe dream. The answer is that we replace the security with options trading at parity. So here's what we're going to do. We're going to explain what the heck that means, because a lot of people get that confused with synthetic equivalencies, which is a whole different animal. Option premium is the most when an option is at the money. That's why when we sell premium, we like to sell at the money options. However, if we go deep in the money with the option, it actually loses its premium and becomes almost completely intrinsic value. We target less than 5%. That intrinsic value moves dollar for dollar with the underlying security. If the underlying security is $10 and the deep in the money option is $5, when the underlying security moves up to 11, the deep in the money also moves up $1 to 6, right? So it behaves like that underlying security, but it's cheap. Now the question might be, well, how far out in time should we go with these substitute options? Well, let me tell you some statistics. Please write these down. In my program, it seems that of the people who are really doing it well, the average length of a trade is 5 months. Now, it's a flat bell curve, which means plenty of them only last 2 months, but plenty of them last 8 or 9 months. So we want to make sure that our back month option is not going to expire while we're still collecting these monthly premiums, because if the monthly premiums are rolling in, why would we want our trade to abruptly stop? Does that make sense? So we're going to go far enough out in time that that's not going to happen. And we typically use LEAPs, long-term equity anticipation securities, because they have a lot of liquidity. So let's do one with our GE. So we could pay $10.23 for the underlying symbol, or if we want one that's definitely trading at parity with only 1.3% of premium left and the rest of it is 98.7, rest of it is in the money value, we could pay $5.30 and use a GE January 2020 $5 call. So let's do the math there. $5.30 for that back month option, 34 cents still to sell premium. Our instant dividend is still $34 per option contract sold, but now it's on a much smaller cost basis. So what happens if GE closed above, that's supposed to say $11 on August 16th. So if GE closes above $11, $11 being the strike price of our front month option, we're going to get this spread, the $11 minus the $5. We're going to get that $6 in cash. So right there, we get 70 cents of profit. Plus, we made the 34 cents up front by selling that call. So we walk away with $1.04 in profit. But now it's on a much smaller cost basis. Look at what happens to our ROI. It shot up to 21%. Now, what happens if GE is flat by August 16? So we paid $5.30. We get to keep the 34 cents, 6.9% ROI, and we just do it again month after month. If you're a weekly option, we're going to do it week after week. How many with the show of hands are following? Good. What if it drops? Well, we've got that built-in profit buffer. You get the picture? Here's ones where I actually did the strategy that we just talked about. 43% on Yandex when the stock traded up, 9% on Guess when it treaded water, 2% on Bloomin' Brands when the stock took a big old dump. So now we've talked about how to supercharge our covered call and our covered put. How about how do we drastically reduce our risk? Yes, there's that profit buffer, but what the heck should we do in order to drastically reduce our risk? And I'm getting really excited about this one. Should we sell half as much option premium? Should we sell out in time options? Should we collar the investment by marrying a protective option, or is what I'm talking about not possible? What do you think the answer is? A, B, C, or D? We're collaring the investment. Let me show you an example. This is one that we actually traded. This is from one of our trading worksheets. This is a tool that we give everybody to track their trades. This was Ericsson. I bought Ericsson for $8.30. I sold the premium for 20 cents, as you can see here. Let me zoom in a little bit so you can really see what's going on. I bought the protective put that protects me down to $8 for 6 cents. Fast forward, I got to keep that premium because the option expired worthless. I kept the stock as well. And I got to sell that protective put. I bought it for 6 cents. I got to sell it for 25 cents. I did it all over again. Sold my premium at 20 cents, bought a protective put. I didn't get as good a deal this second time around. I bought it for 20 cents this second time around. And again, the option expired worthless, and I sold back that put. This time I sold it back for 25 cents. Notice, if you're really into trading, you're picking up on this. If you're not, well, you could be. Not only am I making the money on the premiums, but I'm also now creating a secondary income source by buying and selling the protective collared option position. How fantastic is that? So that's kind of cool, because the last transaction I did, I sold the premium for 50 cents. I saw that it was rising, and I got exercised out at $9. The other thing I'd like to point out to you is look at what happened just after the first month. Notice that my cost basis, which I keep tabs on, this spreadsheet calculates it for you. This cost basis is $7.94, and it went down from there, but I'm insuring this thing at $8. In other words, I'm insuring the position for more than it's worth. How many of you with the show of hands are following that? What is that called? Think about it. What is that called when you are going to get paid more for a position than you have invested in it? Here is that curve again. So let's explain this curve a little bit better. The bottom gray curve is what happens if the trade goes against you. The yellow curve is what happens if the trade goes for you. And if it stays in the middle, that's what happens if everything expires worthless and you just do it time after time after time. Now, when you sell this premium, if you think about the economics, what's the definition of ROI? ROI is profit over investment. Every time we sell a premium and it expires worthless, that profit decrements the denominator, the investment, and I get a new profit. So that creates this really cool thing where if you hold a position for 5 months, not only does the worst case scenario all of a sudden guarantee you a minimum reward, but the maximum reward and the minimum reward are so close that you don't even care if the underlying symbol works against you, because you're still going to walk away with, what's the difference? 40 versus 48% ROI. How many with the show of hands are following? Yes. And if we hold them even longer, that dropping of the denominator and going up of the numerator in this ROI equation, it benefits us to be a disciplined trader. Rather than jumping in and out of positions, the longer we can stay in one of these premium selling positions and let theta decay work to our benefit, not only is there more return, but there's less effort on our part. That's the definition, by the way, of efficiency. Hope you're getting as excited as I am on this. What do you have when our cost basis break-even price is less than our protective bailout price, like the example I showed you? A risk-free investment, a losing trade, too much complexity, or a pipe dream? What do you think? If you said A, a risk-free investment, you're spot on. As soon as that cost basis dips below where you're protecting it, you have no more money on the table. It's just income coming in. So let's review the 3 steps. Buy or short an underlying security, or buy a substitute option trading at parity. Next, sell a near-term at-the-money option for its premium value. Get an instant dividend, a profit buffer, a discount on the security, an expiring coupon. And collar with a married option that is 1 month out in expiration to protect your investment. Right now, and I would say at least until November 2020, and more accurately, probably a long time from now, we're going to be in a sideways choppy market. After the Trump rally ended at the end of 2017, if you look at a bigger picture, we've been in a sideways choppy market since then, and it looks like it's going to stay that way. It looks like we're up at resistance right now, contemplating another move back down. So doing directional trading using derivatives is really hit or miss. It's a sucker's bet. Whereas if we just work with the theta decay, the expiring coupon component of option pricing, we can generate a serious income. We can insure those positions with collared protective puts for up to 20 times return on risk. And we're not hunting with these trades for, a shotgun approach where some might work, some might not, and hopefully at the end of the month it comes out in the wash. Instead, we're doing it with a sniper rifle. We're only investing in those candidates that are going to make us ongoing income. And I've been doing this for years, and it's much easier and better to have a screener. In fact, if you take a look here at, I'm going to go ahead and go to TradingTrainercom. This is our website. And once I'm at TradingTrainercom, by the way, this is a public website, and I'm very nerdy, and I invite all of you to come to TradingTrainercom and check out some of the articles. I write fresh articles every week. But in the meantime, I'm going to log into our members area here. This is what our members get to see. And we have this screener. And this screener goes through over 11,000 symbols and over 900,000 of their related option chains every evening. And it gives us the tickers to do this on. It finds the best premium ones to trade at. Does that make sense? So we let our screener do the work for us. Once we have a symbol, this is the new tool we're just launching. We call it our PISO. This is our premium selling worksheet. And this takes you by the hand, and you just answer questions about your portfolio. Then it asks you questions about, this is one we did on United Airlines. It asks you questions about where do you see your support and resistance, or I'm sorry, what the underlying symbol is. Then it asks you where you see support and resistance. Then it asks you, are you going to use collared protective puts? And then it says, let's work through, tell me the price of the at-the-money options. Once you've done that, it says, help me find some leaps. And it takes you hand by hand through the process. And check out these down at the bottom. Remember we talked about those 4 strategies? Look at this. It tells you exactly what you're going to do. Go short 300 shares of United Airlines. When? After a top has been found. For what? A price greater than 87.14. It tells you step by step what sort of transactions. If you want to do the bear put diagonal debit spread, in other words, selling a put against a leap, just follow the instructions. It's made especially so that you don't spend much time. You can even put in the details of either a hypothetical or actual trade that you're doing, and you can compare them. Notice on United Airlines, in the worst case scenario, we were talking about 4.8% reward versus 0.8% risk. When we actually did the trade, we wound up popping out 12.8% and only risking 0.89% to our portfolio. That's less than 1% of your portfolio up for risk. This worksheet has a little bit of AI built into it, and it does everything for you. The combination of that worksheet with the screener, it's just an income producing portfolio at your beckoning. So I only have about 5 minutes here. How would you like to never miss a pick, minimize the amount you spend away from your loved ones, and have support whenever you need it? Because that's what it's all about. Saving time, creating clarity, getting the results. So would it be okay if I take a couple of moments? I want to tell you a little bit about my materials, my training, and tools to see if they're a match for you. Awesome. I appreciate that. So let's get into it. This is for someone who doesn't want to pay for multiple data subscription, wants everything they need in one place, doesn't want to miss an opportunity, wants to spend more time doing other things, doesn't want to do this alone, wants support, and wants step-by-step instructions. Really, it comes down to someone who wants to get consistent, reliable results. Charlene had cancer, was a teacher. She was a teacher for 29 years, but it wasn't enough time to get her full retirement or even Social Security. She had to get out of the classroom. They actually pushed her out. She was too weak. She thought she was going to pass away, and she was, peaceful about it. And here's where it really sucks with especially what it is like here in the United States. She recovered. And you would think that would be something to celebrate, but now she had a ton of bills. She had no livable retirement, not able to collect Social Security for 10 more years. And then she got interested in the stock market, and she met me, and the rest was history. She writes, the Instant Income Calendar tool is very easy to use. All you do is read the daily table, find the stock you're interested in, and follow the strategy set out for you. I use this along with other strategies to diversify my financial plan. I recently made 14% by just spending about 15 minutes reading about the company, following the chart, and then waiting for expiration. So Charlene can do it when she's weak from chemo. The inner city kids can do it on 30 minutes a day in front of a computer with no money and no real education path past about 4th grade. Here's what the program is. It's 6 months. You get to be part of a once-a-month live training webinar. This is where we take deep dives into the different pieces, and of course, we put up the replay. This is the part I like the best about our program, the weekly webinar workshop. This is where once a week, every Thursday, we're going to have one in 2 days. People come and they throw their tickers that they find on the screener at us, and we work it out in front of everybody. And at the end of the workshop, you get handed a full-on setup that you can go take. Add it to your portfolio. You get to see us do it week in and week out, so you get to learn that way. We actually have people who have been part of this program for over a decade, and I keep asking them, I'm like, why do you keep coming back? And they're like, well, we've learned it, but we rather you just set up our thing every Thursday and we'll just add another investment based on what you set up. So you could do that. That's a minority of people, or you can, usually after about 3 or 4 visits to our workshops, you'll have a clue how to do it all by yourself. Also, you can ask me questions by private message. And that's really important. Here's my commitment. When you come to our program, I want you to reach out to me when you're about to do your first investment. I want to look over what you're about to do before you actually place the trade. I want to give you a thumbs up or thumbs down. Make sure you're aware of any gotchas that I've identified through doing this for over 20 years that you may have missed. How does that sound? That's what I thought. As a bonus for the Trader Talk Live, I'm going to give you a strategy session with one of my coaches. And most importantly, I have a double your money back guarantee. I guarantee that you're going to be making a profit at the end of my program, or else not only am I going to give you your money back, I'm going to give you out of my pocket 2 times my money back. You just have to follow the step-by-step instructions. That's it. It's almost a no-brainer. So I want you to go right now. In fact, I'm going to go with you to optioninvesting.org/TTL. optioninvesting.org/TTL. I believe that'll just pop up in the chat section over there. optioninvesting.org/TTL. In fact, let's just visit it really quick. I think I have a browser up. I just want to make sure it's working. optioninvesting.org/TTL. Go. And you should come to an order form that looks like this. There's some more testimonials if you want to hear more from other people. The price is $497. You're going to be with me for the next 6 months. I'm going to handhold you through your first trade. You're going to come to the workshops. You're going to get the screener updated every night with picks to focus on. You're going to get the premium selling worksheet, the new PISO that does everything for you. So all you have to do is follow the plan it spits out. And you're going to get our trading worksheet so that you can manage your positions and keep track of them. Everything is recorded in replays, so if you have to miss the live webinars, no worries. In fact, with respect to the setups after the Thursday workshops, we actually publish those out in text. $497. Don't pass go. Don't collect $200. Get that free strategy session that we're offering. You deserve it. And your loved ones deserve it too. Thank you so much for letting me go over by a few minutes. My name is AJ Brown with TradingTrainercom. You can send me email if you have any questions at aj@TradingTrainercom. You can give us a call at our office. Phone number's right there, 970-266-8146. I'm personally at extension 87. Love to see you part of our program this Thursday, in on the workshop, taking your first investment. And that's all I've got.